Welcome to the Money Tree Real Estate Investor Podcast, where we learn from real estate professionals across the industry. They will share about how they got into real estate, the big wins they have celebrated, the mistakes they have made along the way, and the advice they have for anyone following in their footsteps. Money really does grow on trees. Hey everybody, it's William here for another episode of the Money Tree Real Estate Investor Podcast. Today I've got a special guest, Adair-Rios. I understand that you were in acting and did a little bit of stuff in Hollywood, and now you've transitioned a little bit into real estate. So go ahead and introduce yourself and let us know who you are.
Hey, yep, I'm Mark Adair-Rios. Thank you, William, for having me. And I grew up here in LA, and like I was saying, you could pretty much throw a rock and hit somebody who is in the business out here. It's pretty natural for people to grow up out here and somehow end up into it. I think I had really good hair back then. I had some dimples, and so it was actually easy for me to do to think about being on camera and doing some work on that side. So got into it, quite a long time ago. I still have some ties into it, which I'll talk about, but about 30 years ago, I'd say 32 years ago, I became a professional actor and doing films and TV and theater. And, I kind of made it my life, made it my living. Lucky enough, to have done quite a few film and TV projects. So, yeah.
It's awesome. What was your favorite project?
Oh gosh. Um, there's been a lot. I got to work, I like to tie it in with some of the people that I've gotten to work with, and anybody who wants to really kind of dive deep on some of the things I've done. I always just say this so I don't come off like a jerk and just start recounting my resume. Just go ahead and put my name inside Google as you're listening, and you can see as much as you want. Or if you know what IMDb is, you can go ahead and punch my name into IMDb. But I look at, so here's the thing. When you're in the business, putting aside all of the dreams of stardom and everything, really underneath it all, we're all a bunch of carnies, right? It's like a big carnival. And the people that you're surrounded with, they're the same kind of, I guess, free spirit types. We're all carnies. We're show people. And for me, maybe it's in my blood. My father was an entertainer as well. I think I have that gypsy kind of nature in my blood. And that's what I love about it. So when I think about some of my favorite, experiences doing some of these things, of course, the acting is cool, but the time you're actually acting when you're on a film set for 5 weeks, the time you're actually in front of the camera and doing stuff, most of the stuff that's happening is off camera or in between takes or hanging out with people and getting to know people. And again, that gypsy thing where you create these little families. And so that's how I kind of put it together. So I've had the experience of working for great periods of time, say up in Canada, in Vancouver, where I did a couple projects up there. And one was a pilot. It was a Sherlock Holmes movie, and I was kind of like this young tech geek kid that kind of joins Sherlock Holmes, and we go try to fight crime. Another was I got to do a couple projects in Miami just because of I'm Latino, and I guess they wanted me in the tropical areas, but I got to do this show called Drug Wars. It was about the Colombian cartels, and I got to spend a whole bunch of time in Miami playing this assassin, for the Drug Wars movie. And then New Mexico is really, I got to spend some time in New Mexico filming a movie, and I met some really good friends out there that I kind of made friends for life, and love that love that state and the people out there, and yeah, I'll never forget that. So.
It's pretty cool. Yeah, and I mentioned beforehand, I just got back last week from my first vacation on the West Coast, and got to go to Universal Studios, and I love movies, love TV shows, and
Sure.
that was really my first time to see how complex they are. There's
Right
so
on.
many things going on behind the scenes.
Yeah. Oh, yeah. Listen, I mean, every movie you see, the bigger you get, the more people are on. But anything that you see that's pretty much on TV, that's at scale, is you're probably going to have 100 people behind the scenes doing whatever. And so that's what I mean, like it's a profession with craftspeople who are, 99, 100% completely professional. And um and it's awesome, because you get to meet people from all walks of life just out there just working and doing their thing, and that's what I love about it.
And that's one of the things that I've loved about real estate so far, between the podcast, the Zoom calls, phone calls, and
Mm,
face-to-face interactions, whether that's a conference or getting lunch with somebody, I've been able to build like a lot of cool connections and,
that's awesome.
meet somebody like you. I mean, there's no other way I would have met you but
Yeah,
through real
yeah,
estate, I
yeah.
think.
Yeah, totally. What's really interesting is so here down in Southern California, it's kind of a joke now, but in order, there's a few professions. So when you're an actor, you have to make money. That's the very first thing. And it can take a long time. And it's a very hard profession to be in. Anybody who thinks that, actors are flighty and whatever, that's totally fine. And many of them are. But the reality of it is that actors individually are entrepreneurs. You have to create a business for yourself, and you have to keep motivated every single day to get yourself out there, to go on your auditions year after year, day after day, month after month, in face of enormous amounts of rejection based on your look, right?
Yeah.
And how you are. Like, you're getting rejected on stuff you can't even change,
Right.
and you stay in there because you're just following your dream. The fantastic thing about real estate is, out here, in order to make money, you can go into the bars because you work at night, so there's flexibility during the daytimes, or people become realtors or they get into real estate, and yeah, again, it's a little bit of a joke, if you look at pretty much any real estate agent out here, they're probably on IMDb, and they're probably actors as well. So at a certain point, I kind of fell into real estate, although I had some ties to real estate from when I was younger. I actually bought my first piece of land when I was like, I don't know, 17, 18, on a land contract. And so I've always just, wanted to learn and know everything I could about real estate. And luckily I fell into investing. And at a certain point, of course, I did become a realtor, but I was more on the mortgage loan side. And then after the crash, I kind of dove into um, dove back into my real estate investing and into the commercial side. And then that's when I learned about syndication and finance and multifamily, passive investments. And right now, I'm moving on to raising money for my first fund, which is a fund of funds, and kind of, looking back on that progression, going, wow, things have really changed, especially becoming professional in the real estate side of things.
That's awesome. Yeah. So for those listeners that don't understand, can you tell us what a fund of fund is, what
Oh
that
yeah,
model looks like?
absolutely. So, when you think of a real estate fund, real estate funds generally are, these are companies that are raising money from investors in order to buy properties, and usually they buy a portfolio of properties within a certain fund vehicle, basically. So you'll see a real estate company, and they're buying a value add fund number one, say, and they raise $30 million to go out and buy, say, 10 properties and put inside that fund. And they have investors in there that contribute, 100,000 to millions of dollars in order to put into that fund and get the returns from that. A fund of funds is basically another fund on a smaller scale that is raising capital from investors, usually from friends and family, and they're raising it specifically to place money into those funds. So let's say, me, Mark, I know a fund manager who says, "Hey, if you can invest $1 million, we will give you a certain, we'll give you better pricing at that price level versus if you came in at $50,000, and we'll make the split better, and maybe we'll increase the preferred return or something that makes it what we call premium pricing." So within the fund of funds model, I can go out and raise $1 million from my investors, right? and take that $1 million, and my fund of funds is actually an investor investing in the overall fund. So that's, in a nutshell, how that works.
Okay, so with the fund of fund models, an accredited investor and a non-accredited investor can invest with you.
It depends on the structure, and it depends
Okay.
on which fund of funds, how they're what exemption that they're using with the SEC. So my fund of funds, I'm doing what's called a 506c, which is only taking accredited investors, which I'm
Mm.
sure your listeners know. But if they don't, basically an accredited investor under SEC rules is, $200,000 in W-2 or income, basically, for 2 years, with the expectation that it's going to continue. Or if it's married, it's 300,000, or a minimum of $1 million in net worth, not counting the your personal residence, right? And that can be, anything, that counts towards your net worth, like, I don't know, stocks, bonds, equity, cash, crypto, whatever you want to. All of that can go into that bucket to build up that $1 million in net worth.
Got you. And so how are you compensated for being a fund of fund manager?
So typically what we do is we balance between getting premium pricing from the fund level, the third party. And we do take a small asset management fee. What I do on my fund of funds is I waive the asset management fee for like 2 years, something like that. And that's just to keep the lights on, stuff like that. And then we do a little bit of split. So the way I run mine, and you can see them structured all different ways. But the way I do it is I for 2 years, there's no asset management fees. I return all of the investors' capital, and then we do the splits once they're completely made whole. So,
Awesome. Okay, cool. So, a lot of the listeners, they've been asking a lot of really good questions, and they want to really dive in and get more technical.
mhm.
And so obviously you've got a background with finance, and structuring some debt. So uh, walk us through, let's say we've got a $300,000 home.
Okay.
And then that's example number one. And then we've got a $20 million multifamily property. So what are your qualifications to purchase each of those?
Mhm.
And then what are the types of debt that are available to
Cool.
use for these purchases?
So on the $300,000 home, I guess you have to try to figure out what you're going to do with it, right? What type of investment is this going to be? Are you going to flip this house? Put money into it, buy it at a really good price, put money into it, and turn around and sell it in a couple of months once you've rehabbed it and made it really nice. Are you going to hold it as a long-term rental, right? Are you going to, maybe it's in a great area that's a lot of people, there's a lot of kind of tourist traffic or whatever, and you're buying it as a short-term rental, right? You can buying it to put it on Airbnb, and then you can rent it out for cash. So there's various things you can do on the investment side. Just keeping in mind that single family homes, no matter what your plans are to do with it, they are not commercial property. You might have a business plan that's more quote unquote commercial, but in terms of the property itself, it's not considered commercial. In fact, anything from 1 to 4 units is considered, single family or multifamily residential. And because of that, there's a certain type of loan product that's really attuned to the single family and 1 to 4 kind of space, right? And then 5 units and above generally will get into commercial property on the technical side, but really commercial loans, there's a little nebulous area in there between 5 and, let's say, 30 units that technically it's commercial, but it's still like multifamily if you're talking, residential side, um, apartment buildings. So, um, depending on what you're going to do, that is the type of loan product that you're probably going to go towards. There's certain types of loan products, say for the short-term rental space, where usually you'll have to put, say, let's say 30% down. It might be going up now, 35% down, so 65% loan to value. You bring 35%, and a bank who is okay with the short-term rental type of income, they will loan you 65%. You might go up to on those, you might go up maybe to 70%. I'm not really in that space, but I will say that it's definitely a risky space because the money that's coming in, it's a little bit volatile, right? It's very seasonal, and you really can't guarantee because they're short term. They're only the leases are only for a day. You can't guarantee what the income is going to look like. You really only have historical kind of income. If it's a long-term rental, I'd say right now on a home like that, lenders are doing they're doing something the same. I'd say about 65-70% loan to value. That's generally going to be recourse debt, which means you're going to have to guarantee the loan if it's a bank or some sort of lender. And you got to have a good credit score. I think your credit score on all of these single family homes is going to have to be probably at least 680. You're going to want it, in the 700s, probably in 720s, even better to get better rates.
Right. And so just to pause for a moment, so you mentioned recourse loans.
Mhm.
So that guarantee is basically putting some sort of collateral on the line, correct?
Not necessarily. It's more that they're going to. I call it a financial proctology. The bank is going to look up into your finances and to see that not only can you handle this on a credit side, the capacity side. Do you know what I mean? Do you have a side job? Like, can you if something happens with the property, are you able to back it up with additional funds from your savings or your liquid reserves, stuff like that. But recourse generally means that you're just guaranteeing the loan, right? So if anything happens, they foreclose, and maybe say you got a $300,000 loan, and something happens, they foreclose on it, and the foreclosure sale only brings in 250,000. Well, they're going to come after you, depending on the state. They're going to come after you for that last $50,000. So that's what it means to personally guarantee the loan. It could, if they don't get anything for it or something happens to it, they can come after you for the full 300,000. That's rare, but and so that's the reason why you don't want to over leverage your properties on single family houses. Just because you can get 80, maybe, in some circumstances, 85% loan to value doesn't mean that you should, you know, and this is when we start getting into, we becoming big boys and girls, right? And you have to think about, am I over leveraging the property just because I can't raise enough equity in order to get into the deal, right?
Right.
So, something
So
to
how
think
does
about.
that differ? How does that differ from the multifamily properties?
So for multifamily, generally, especially the size that you mentioned, a $20 million loan, the very first thing is typically with local banks and maybe regional banks, actually all banks in particular, uh, typically you're going to have what are called a non-recourse loan, which means that generally, with a few exceptions, the bank or the lender will only be able to go after the property, and they won't come after your personal assets if something goes wrong, right? They call those non-recourse loans. But these properties, they go through pretty rigorous underwriting to make sure that they cash flow, and they typically have longer term leases, in inside the property, and they typically have multiple units inside. So a $20 million property right now is probably going to get you, maybe 100 units, let's say, 150 units of multifamily. And so think about in comparison to one house. You have one renter in the house. If that renter leaves in the middle of the year, well, now you're 100% vacant, right? If you have a duplex and one renter leaves, well, now you're 50% vacant, and those are unacceptable kind of vacancy rates, right? Well, in a multifamily property with 150 units, you can afford to have, say, 20, 15% of those people leave and not even worry about whether or not it's going to cash flow or not. And that's one of the big differences about scaling up. My personal opinion is scaling up, as quickly as possible when you feel comfortable is critical if you want to stay in the game, especially commercial real estate. So in terms of the lending side of things, when the way they're looking at it is, hey, we'll go non-recourse on it. You're just going to sign what are called carve outs. You're going to sign bad boy carve outs, which are, hey, you're not going to do any fraud. I promise not to do any fraud. I promise that I'll put insurance on the property and make sure that there's adequate coverage so that something happens, the bank will be made whole. I promise not to do anything that's going to materially jack up the property, things like that, right? You're promising those things. And if you do fraud, or you don't put insurance on the property or something like that, then it turns into a full recourse type of deal. Pretty simple, and most of the things you're going to look at them and go, I would never do that. I mean, I would never do that. So it's not even an issue. Now, the thing about going bigger is you have to figure out, well, how am I going to get, $3 million to put down on a $20 million property? Where's that going to come from? And that's when you start getting into syndication and passive investors and all that stuff that that you probably talk about here a lot. You have to use partners. In fact, I would say if you're in a $20 million deal by yourself, you're probably pulling your hair out because there's so much stuff to do. Unless you're just rich and you inherited a lot of money, and you know what I mean. You can just go out and buy a $20 million property.
That's not me. I'll tell you the truth.
So yeah, those are the major things. I think that, in terms of qualifying, yeah, they're gonna have a hard time looking at you if you don't have any experience and you're trying to take down a $20 million property. You're probably going to want to work your way up or partner with somebody who has that experience. And there's plenty of groups out there now that do have experience of size that you can team up. It's just for you, if you're really interested in working on the active side, it's just, you got to figure out what your superpower is and what value do you bring to these groups in order to get in on these bigger deals, because they probably already do everything that you can do. So how are you going to bring value to them?
Passive investors in real estate are able to receive a check every month. Some people call that mailbox money. We say money really does grow on trees. Visit the website at biggerpictureholdings.com, where we have a ton of free resources to help you learn more about planting your very own money tree. Man, I appreciate that. I guess the last few things. So, one of the things that I want to do with my investor base, everybody talks about all the wonderful things about real estate, how much money they've made, all the success that they've had. I definitely want to highlight that. But before we do, I want to maybe talk about something, lessons that you've learned, a loss that you've had, some of the pitfalls that you've seen, that way people can be aware of both sides of the coin.
Sure. So we were in a deal. We were in a student housing deal, and this was pre-COVID, and but it kind of went through COVID, and we went into a market and where we were really gung-ho about the asset class. Student housing has some great things about it, especially because the leases are guaranteed basically by the parents, right? Some kid can't just go in
Yeah.
and get a student housing. The parents guarantee these leases, and that's fantastic, right? Because now, at least from one level, if the parents are paying attention, you're getting buy-in from them in terms of them keeping their kids in line, right? At least in terms of, hey, don't mess up the house, don't do anything to jack it up, because the landlord's going to come after you, because you're guaranteeing it. So we went into a market, and it wasn't all rosy, right? But it was connected to a fantastic school, 40,000 enrolled students, one of the biggest schools in the Western states, and so an institution that's been there forever. And so, we felt very comfortable going in with this product. Our product was just a little bit outside of the 1 mile ring that you want to be with student housing. And little did we know is we actually purchased right at the time that the market was shifting a bit. We didn't see, unfortunately, this was a mistake, but we didn't see all of the construction permits that were sitting in the queue. Not the construct. We looked at the construction and the absorption rate, but we didn't see all the potential permits that were coming online in the next 2 or 3 years. And sometimes it's impossible to see that, right? Because they don't start projects, but 18 months to 24 months out. And it turns out that the city was clearing out space right next to the school in order to allow for these big, giant, brand new tower type student housing projects to come in. And I'm talking 4,000, 5,000 beds, 6,000 beds in total
Uh-oh.
over a period of 2 or 3 years.
Yeah.
Enormous amounts of beds coming in. Now, the weird thing about, I mean, this makes sense, but the thing about student housing is the kids, they have shiny object syndrome. So every year when they go, they think about, okay, we're going to go find a new apartment. Great. The kids are like, I want to live there. It's got a Starbucks in the bottom. It's got a rooftop pool. There's a bar. Like, you know what I mean? It's got hardwood flooring and stainless steel freaking, appliances. I want to live there. And it's $1,000 a month for my bedroom, but I got my own bathroom. And,
Right.
we're over here and we're charging $500 a month, reasonable, in these great, types of properties, but we're outside of the area and we don't have a pool. We don't have a Starbucks, stuff like that. And so really we got beat up by all of these big giant student housing properties. And, we went from another key feature about student housing is you pre-lease throughout the year, right? And then you do like a mad dash right around, I'd say May and June, right before the school year is over, to finish up, what you didn't pre-lease through a year and get ready for fall. Well, typically, you'll be pre-leasing throughout the year and the students will look at your place. Well, when these new ones came in, they were getting looked at first. And so our leasing season started way late. Like nobody was leasing from us
Wow.
until like April. And that was really terrifying because we only had 2 months to fill in, 150 beds. Like, and so we had some really, really, really scary times because we have investors, right? And so our main thing was making sure that the property made enough money to make sure that their money was safe. And so there were some times when we couldn't distribute, unfortunately, and and then COVID hit, and that changed the game everywhere because of
Yeah.
remote schooling. Now all of a sudden, all of our students are coming to us saying, we're not going to be in school next year, so we're not gonna lease. So we had to change our plan and convert it to multifamily, and that took time and stuff like that. Unfortunately, we were able to convert it to multifamily and actually change it out of student housing. And it turns out
Nice.
that our type of unit was perfect because there was nobody in the market that was offering this type. And the regular multifamily, even though a little bit less, we weren't getting those juiced up student housing rents. Um, we at least kept it enough full that we could put it on the market and sell. We didn't sell at a loss. We made everybody's money back, and we made a small profit. Right? We made a profit. It was a small one, but it was less than what we had projected,
Right.
and that's real estate.
Right.
Sometimes you can't hit a home run, but I'm very proud that that we made everybody's money back and we got out of it. Thank goodness, because it was scary.
Definitely.
It was scary. I mean, literally, I was, I'd have nights when I'm just laying there sweating, like, oh my god. I would fly out there and I would be, literally going out there and doing, work on the property to make sure that, the property is kept in good shape and, was looking good and all that stuff. And yeah, so
Well, I appreciate you sharing that,
yeah.
I think it's good for people to be aware
Oh yeah,
of
100%.
things.
I mean, listen, not all of them work out, and there's a lot of geniuses that were in this low interest rate environment that we just came out of. There were a lot of geniuses that were made, but nobody's a genius in this business. It takes a lot of hard work, and I think that I, for me, I don't know what it is. I think everybody does. Like you're pretty much going to encounter 90-95% of people that really have the interests of the stakeholders in mind, right? The investors, the renters, the vendors, and the people that work under you. But ultimately, you make a promise to your investors, and you got to do everything you can, everything you can to make sure they're made whole. No, number one. Really, I'm a transaction guy, so I get juiced up by when we get into a deal and we're going, and there's a lot of heartache sometimes in terms of like day to day, like but in the end, there's a lot of wins there, which I love, right? It keeps you going. But we actually exited a deal. I just sold a deal back in, I think it was November we closed, and the property, we held it for 2 years, I think 2.5 years. And we ended up making something like a 28% IRR in those 2 years, which was just fantastic. I mean, but I will say this, 2021 was one of the best years for real estate ever because interest rates were, 3%, 3.5% on multifamily. So no geniuses, right? It's just, we were a product of the market. But I'll take credit for it too. Just don't think that, we were out there doing anything special. The market really helped us along in a lot of ways. So
That's awesome. Yeah,
yeah,
well, thank you so much for sharing your stories. Just loved getting to hear all those, and I know the listeners will really appreciate them as well.
yeah, totally, absolutely. And if you want to find me or reach out again, you can do the whole thing and look me up on Google and everything. But I can also be found at birchstonewealthfund.com. That's my fund of fun website. And also keep an eye out for my podcast called 10X for Gen XYZ. We've been out it's our second season now. So if you go on Spotify, you can do a search for that and find us there.
So yeah, we'll have those links in the comments. Mark, thanks again.
Cool. Thank you, William.
Like and subscribe below. A new episode will air every Tuesday at 7 a.m. Are you looking for more content? Visit our website, biggerpictureholdings.com. And remember, money really does grow on trees.